Hi, everybody. Welcome to this panel show in which we are talking all things pensions. I'm joined, as always, by my co-host, James D'Souza. James, how are you doing?
I'm very good, Mark. Thank you for having me on again. How are you doing today?
Yeah, I'm all right, thank you. Yes, yeah, and as always, we come with backup. So we're here with John Hurst from Charles Dean Limited Financial Planners. Thanks for joining us.
How are you both?
We're good.
Good,
Yes,
thanks.
really good. Thank you. Excellent. I think the three of us have got a tough task on our hands here because we need to find a way to make pensions sexy. So how are we gonna do that? How are we
By
gonna
keeping our clothes on as well.
Yeah.
I've had some jobs and some tasks in my time, but
Yeah, exactly. Yeah.
no. Hopefully throughout our chat today, I'll get you to see that whilst pensions, they do have a bad rep, and I'm not going to sit here and defend the pension industry because in some cases it's pretty indefensible. But if you are savvy enough and kind of switched on enough, there are quite a lot of different ways that you could use your pension funds to either further your own portfolio or potentially help others further their portfolios as well.
Cool. Well, that sounds like a pretty good place to start.
The thing with pensions, really, it really depends on what you want to do with them.
Yeah.
And it depends what your kind of appetite and your kind of overall plan is. So without kind of giving too much away too quickly, you can buy certain types of property with your pension, and you can also make certain types of loan from your pension scheme as well.
I've got loads of questions on this stuff because it's it's an area that I'm really interested in and interested in knowing more about. So I've got a load of questions. What I've also done is I've put the fact that the three of us will be chatting all things pensions out onto our Facebook community, and I've asked our community over at the Property Wealth System Facebook group what they would be interested in finding out. And one of our community members, Lynn, has asked about a SIPP pension and how she could go about using that in terms of growing her property portfolio. So what I understand Lynn's talking about, there is a particular type of pension. So that sounds like a great place to sort of kick things off in terms of what are the types of pensions and how do they work?
Yeah, sure. It's a really good question from Lynn, actually. I suppose just before we do get into it, just with my regulatory hat on, kind of anything that we're going to discuss today is purely kind of for illustrative purposes.
Yeah.
And obviously the suitability of anything that we discuss today is going to be down on an individual level.
No personal advice, anything like that.
Brilliant. Hats off now. So, right. Basically, with personal pensions, I will kind of get round to answering what a SIPP is, but I think it's important just to kind of give a bit of background, really, and discuss the other types of pensions, just in the interest of fullness. So, Lynn, I will get round to answering what a SIPP is, I promise. But, so you've got three main types of pension. Okay, you've got state pension, which you get when you get it, basically.
That's your £115 a week.
Yeah, or whatever the equivalent is whenever they decide that you can actually get to state retirement age, which 68 at the minute for a lot of us, but based on kind of just my opinion, that will go up as well over the years. But there's not a lot in terms of using your state pension to help you kind of build your portfolio and progress. There's nothing that you can do, really.
Yeah,
that's just, I guess, for a bit of pocket money in old age. That's all we need to view that state pension as.
Yeah. Then in terms of your kind of individual pensions, they fall into two categories. Okay, you've got defined benefit pensions and you've got defined contribution pensions. Okay, and the key thing to probably take away from that is that in a defined benefit scheme, what you get at the end is defined by the benefits you were on whilst you were working there. Okay,
right.
So the most common example of those, and what most people will probably know them more commonly as, is a final salary pension.
So a final salary, yeah, because I've heard the term, but I think they are they're more difficult to come by, aren't they? I think.
Yeah, they're like gold dust, to
Yeah.
be honest.
The police used to have them, and it was only certain industries that had them.
It's mainly nowadays. It's only mainly public sector.
Yeah.
Again, we could probably spend a whole podcast talking about those schemes, but the key to remember with those is that they will pay you a guaranteed income for life.
Yeah.
Okay. So in the eyes of the regulators, insurers, providers, it's almost a case you've got a guaranteed income for life. Why would you give that up?
Yeah.
Okay. So it's not to say that you can't look to do something with those types of schemes.
Yeah.
It's just that there is a lot more, and rightly so, there's a lot more regulation and kind of red tape behind them. So
yeah,
if anyone does have any of those types of schemes or think they might have any types of those schemes, I would say if they just want to get in touch, I'm happy to kind of spend a bit of time just going over the pros and cons of those.
So for the purposes of this conversation, we'll sort of park that type of pension and then look at the types that the vast majority of people will be more familiar with and that can potentially be used to build a portfolio.
Absolutely. Yeah.
Okay, great.
So with your kind of defined contribution side of the pension schemes, the key there again is that the money that you get at the end is defined primarily by the contributions that you make in. So most people nowadays, if they work for a company, will have been automatically enrolled into a workplace pension scheme, as is the legislation. So those types of pensions we would bracket into the personal pension side. Okay. And those pensions, they're not designed to do anything spectacular. They will traditionally be invested in a default investment portfolio that one of the big insurance companies have decided where it should go. You don't really get that much control over it, and when you do, you're normally contained to a set number of investments that you could make. But like I say, they're not designed to be anything spectacular. That's not their remit. Then kind of the next step up from personal pensions, you move on to SIPPs.
Okay.
And SIPP stands for self-invested personal pension. Now, the key there is the self-investment part of it. And SIPP, to be honest with you, there are a lot of companies out there that will call their product a SIPP, but it's not really a SIPP.
Right.
So I'll elaborate on that. So some of the key things that a SIPP will allow you to do is straight off the bat, and probably the most kind of important for your listeners, is you can buy commercial property.
Okay. Yeah.
So your pension could own a commercial property.
Does it have to own that outright, John, or can it obtain finance to buy that?
So you could do it one of three ways. Okay. You could buy it outright. Yeah. You can gear up a SIPP. So you can borrow 50% of your pension's value into the pension.
Okay.
So say if you've got £100,000, you could borrow an additional £50,000 and essentially get a mortgage against your pension.
So you can effectively leverage your own pension. You can gear up your own pension and borrow against it.
Correct. Yeah.
That's interesting. Yeah.
The borrowing as well, it doesn't have to come from sort of your traditional sources either. It could come from a bank. It could come from an angel investor. It could come from a JV partner. It could come from yourself. If you had the cash sat lying around, you could be the borrower to your pension. So, or you could part purchase within your pension. So say if there was 2, 3, 4 or 5 of you, however many, and you all had a little bit in a pension, you could all buy a percentage of that property with your own pension as well.
Syndicate kind of mentality.
Essentially, yeah. It doesn't have to be with another pension either. It could be with just another investor, another individual. it doesn't really matter, to be fair.
So this applies to commercial property. So what are we talking? We're talking office space,
Shops.
retail space, yeah, that kind of thing. So presumably, potentially as well, if you own a business premises, that kind of thing, would that work?
Yeah. So to give you an example of
Yeah.
a kind of a deal like that we've done with a client. Client was working out of a factory. They make boxes, and they've been working out of a factory for a decade or so, and the opportunity arose for them to buy the factory.
Okay.
So round numbers, factory's worth £1 million. Okay.
Yeah.
Client had £200,000 in their pension. Okay. So what we did is we made a contribution from the business into the pension.
Yeah.
That contribution attracted corporation tax relief.
That's a business expense in effect.
It essentially comes off your top line profit.
Yeah.
Yeah.
Okay.
So contribution into the pension scheme builds up the money in the pension, builds the buying power. Yeah.
Yeah.
We then went to a borrower. In this instance, it was a bank.
Yeah.
Because the client already had a relationship with the bank, so it made it a little bit easier. The bank then borrowed into the pension scheme, so it lent the pension scheme £100,000.
Yeah.
To give the pension scheme £300,000 worth of borrowing power.
Okay.
And then it then lent to the limited company to do the rest of the purchase. So it was essentially a 70-30% split.
On that topic, John, is there a cap as to how much a business can actually then contribute to a pension if this is potentially a way to alleviate some corporation tax?
It's an interesting question. Yeah. As with anything pensions, it's not a simple, straightforward.
Yeah, fair enough.
So basically, you get an annual allowance of £40,000
as an individual, each person.
As an individual, yeah.
Okay.
Yeah. Providing that you meet certain criteria, you can go back 3 years.
Right.
And use any allowance that you didn't use up in those years.
Okay.
So the maximum you could do in any 1 year is £160,000, which is 40 in the current year, and then 40 for the last 3 years.
Times 3 years.
Yeah.
So in this situation, I guess your client hadn't maximum utilized his allowance from previous years, which is why he could then boost that quite substantially in that 1 year.
Correct. Yeah. I mean, they had little bits of pension lying around, which we kind of pulled together, and then they made a contribution on top. Yeah. So that 40,000 though is your maximum tax relievable allowance. So that's the maximum you would get tax relief on. You can make more than the 40 in any one given year. You just wouldn't get tax relief on it. So
it doesn't become quite as sexy, I guess, doing it that way.
Well, yeah, to kind of borrow a phrase from Mark from earlier, we're not making pensions very sexy then at that point. We're not getting tax relief. So, so that in that scenario, so the contribution can either come personally or through the business. If it was from the business, you can claim it as a business expense. If you make it personally, you can claim personal tax relief at your personal rate of income tax. So if you're 20% taxpayer, you get 20%, 40% gets 40, etc. The key benefit, though, of kind of that scenario is once the purchase has gone through, you're then paying rent from your business into your pension.
Okay.
Because you've got a landlord-tenant relationship then.
Yeah.
So rent is a business expense.
Yeah.
That you're then paying into your pension.
And it's building your own tax-free, I guess, pension.
Yeah. It essentially becomes a self-fulfilling circle at that point.
So your pension has enabled you to invest in property and add to your portfolio if you like, but at the same time, the property then is enhancing your pension pot.
And one of the, I suppose, sexy benefits of that is that there's no capital gains tax within a pension.
So that factory you said was $1 million. If, let's say, in the future your client sells that for $2 million, the pension doesn't have to pay any tax on that gain as such.
On its percentage of the ownership. Yeah.
Yes.
Well, what about inheritance tax? How does that if there's property owned by the pension, which is essentially a trust? Is that right? So how does that work when it comes to inheritance tax?
So any asset held within your pension, as you quite rightly mentioned, a pension is effectively a trust.
Yeah.
So it falls outside of your estate for inheritance tax purposes. So
what is there any tax to be paid on that then?
It depends. Again, with pension, it's never a kind of a straight answer. So taking it a bit morbidly, if you were to pass away, the tax rules basically depend on how old you are and whether you've accessed the pension or not. Okay. So if you're below 75 and you haven't accessed the pension, then there's no income tax to pay. So basically your beneficiary could get all of that. Okay. Again, to kind of touch on that point there, it's income tax that they would pay on death and getting the money back rather than inheritance tax.
Yeah.
If you've accessed the pension, so let's say you've taken your 25% tax-free lump sum, for example, which is what you're entitled to after the age of 55.
Yeah.
Although that's going up to 57 in 2028. But
okay.
Yeah, for the purposes of this chat,
Today.
You get 25% tax-free lump sum, basically. So pension's worth £100,000, you get £25,000 tax-free. The rest of that you can have, but it gets added to your income. So what some people do is they'll take the lump sum and potentially use that as deposit on some properties. Tax-free lump sum.
And now this is falling outside the scope of pension, so it doesn't have to be commercial property anymore either.
Correct. Yes.
Yeah.
So again, not financial advice, but what some people do is they'll take their 25% lump sum and then, like say, use that on deposits on a buy-to-let or a HMO or whatever their strategy is.
Can I just jump back to in the pension, buying commercial property? Now, is there a line there? Because, for example, a hotel is a commercial property, but it's one of Mark's specialist strategies, service accommodation. It kind of falls under the scope of potentially kind of a good, solid strategy that we teach that a lot of people feel is quite accessible to them. So would you be able to buy, let's say, for example, a hotel under a pension and run it as service accommodation?
Without kind of sounding like a broken record. No, the answer really is it depends on the provider. Okay. So it depends on who your provider is and who your trustee is, because they will each have their own different interpretation of what HMRC's rule book allows. Okay. Because hotels, care homes, social housing, nursing homes, rehabilitation centres, those kind of things, strictly speaking, are allowed as an investment, but it's quite a grey area. So at that point, that's where it's really important that you've got the right pension provider and pension trustee to make sure that you've got someone who has the same risk appetite as what you're looking to do, basically. And as kind of a not so shameless plug, that's where someone like myself would come in to make sure that your provider is matched up with your objectives. To answer your question directly, yes, you can buy hotels, and you can do B&Bs. You can do a care home. You can do halls of residence. Again, each with their own particular set of rules. A very, very, very common question that I get from a lot of our property professional clients is, can I do service accommodation, HMOs, Airbnbs, that kind of thing? And the short answer on that is no. Okay. There is a potential solution to that problem, which again, bringing it back to trying to make pensions exciting. I'll go on to that in a bit more detail later.
Dangling the carrot there.
Yeah. Well, you've got to with pensions, or else. Basically, with service accommodation HMOs, whilst you may own them on a commercial class usage, or they might be commercial mortgage, or it might be through a limited company, for the purposes of a pension scheme, HMRC deem them as residential.
Okay.
And the reasons why is HMRC would argue that someone could live there, so it could be residential.
Yeah.
Now, we kind of, a couple of years ago when we had this conversation, we made the argument to say, well, the idea behind serviced accommodation is that it's for no longer than a 30-day period, for example. So someone couldn't live there.
And it's nobody's prime residence.
No.
Yeah.
But they came back and said, well, someone could.
Yeah.
Well, okay, that was the end of that argument.
Yeah.
But basically, their main criteria, and this is, if you're going to look at doing something like a hotel or something like that, a B&B, is you've got to ask yourself, are those rooms self-contained?
Yeah.
Okay. And could someone physically live there?
Yeah.
If the answer is they are self-contained, then from a pension perspective, it would be deemed as being residential. Yeah.
So a hotel, for example, you've got no cooking facilities, which is why it's not deemed to be self-contained.
Correct. Yeah. So a lot of those types of queries are kind of a case-by-case basis.
Yeah.
Really. The other side of it as well is, and I had this the other day with a query. It was, we were looking at so it's like a 5-year lease someone had with a care company. So it's a HMO, but they'd converted it to a care residence. And the argument that came back there was said, well, at the end of that 5-year lease, it stops becoming a care home. It's essentially 5 flats. Yeah. So that's kind of, if you look at it that way, then you're not going to be too far wrong. But again, it's kind of a case-by-case basis, really.
So SIPPs, you can invest in commercial property.
Yes.
We're probably all guilty of this, in terms of seeing pensions a little bit as something that we park and we put on the back burner, and it's not relevant for us for a period of time. We're all familiar with the idea that we can't access our pension pot until we get to a certain age. But what about what we're talking about here? So does that mean I can't purchase a commercial property with my pensions until I'm 55, or how does that work?
Yeah, no, to the contrary. You could have a commercial property in there right from birth until death. So there's no limit on age as to what type of investment you could have.
So that's what I think makes this really powerful, isn't it? And really interesting, because like I said, we're so used to just assuming that I'll worry about my pension and what I can do with it, until I'm 55 or 57 or whatever it might be further down the line. But actually, this is all about how you can utilize your pension as a vehicle now to help you grow your portfolio. And like we've talked about in terms of renting back again, the opportunity to also bolster that pension pot, over the years.
Absolutely. Yeah. And, the amount of times I've had conversations with people who, get to their sort of 50s or 60s and say, oh, I wish I'd known that I could have done that 20 years ago.
Yeah.
Because then you've got 20 years worth of capital growth on the building that you're not going to pay any capital gains tax on.
Yeah.
You've had 20 years worth of rent that is a business expense going into your pension.
Yeah.
And to use another example, we've got some clients who they own a double glazing business, and they purchased a unit, turned it into a showroom. So the pension paid for a lot of those redevelopments as well.
Yeah.
And then over the years, their rent's built up, and they're now buying next door.
Yeah.
So they're using their pension funds and the money that they paid into their pension to build their portfolio by virtue of just the rent that's been coming in over the years.
Fantastic. That's a great story. Yeah. So there'll be a lot of people listening to this like me now that are thinking, where did I put that? Where's that paperwork? And then let me understand what pension scheme I'm on and that sort of thing. So what about the other types then? So that's SIPP. That's a good overview of SIPP, I think, isn't it? What about some of the other the types?
Sure. Just to sort of touch on one or two of the other things that you could do in a SIPP as well.
Yeah. Right.
Sorry, I got a bit carried away with commercial property. Yeah. So you can buy land as well.
Okay.
You can buy commercial and convert to residential.
Right.
However, and there's always a but, isn't there?
Yeah.
You would have to dispose of the property out of the pension before it was deemed as being classed as residential. So
you'd have to sell it on, but you could sell it to your own company or something like that, can you? Yeah.
And does that have to take place at market value?
Yes. So there's two distinctions you've got to make when you're purchasing an asset within a pension, and that says if it's deemed as connected by HMRC. So if you're buying from yourself or selling to yourself or renting to yourself, you've got to be able to evidence that you're doing that at a fair commercial rate. So a RICS approved surveyor, basically. Yeah. If it's a third party, or if you're just buying from the market or renting to a third party or renting to the market or anything like that, then you're free to negotiate terms as you would kind of any other deal, really.
Okay.
But yeah, it's a good point to raise.
And I suspect that's going to come into play a little bit later in the conversation, isn't it? When we start talking about one of the other benefits and the idea of rent back.
Yes.
Yeah.
What about overseas property, John? I've heard that you can be buying overseas property with a pension.
You can, technically, yes. The difficulty with that arises in that, say if you wanted to buy, I don't know, a shop in Spain, for argument's sake, you would need a Spanish property lawyer that knew UK pension law, and you would need a UK pension lawyer that knows Spanish property law. Yeah.
So it has to be an overseas commercial property as well.
Yeah. It can't be a...
Can't buy yourself a nice villa in Spain.
Not that way, no. There might be another way to do it, but so it's technically you can, but actually in reality probably
complicated.
Yeah. Okay.
Probably cost you more in legal fees than actually. But again, by all means, if you do know a Spanish property lawyer that knows UK pension law, please pass them my details, and there might be some business for them. So that's in terms of properties. You can buy unlisted shares as well. So a conversation I was having recently was an angel investor had set up a company for the purposes of kind of having the funds available to lend out to investors. And they were selling shares in that business,
right,
as a way of them raising finance. So they then had more money to loan out. So you can buy shares in an unlisted business as well. The key there is that your pension and you combined can't be a controlling director.
Right.
So as long as you don't combine own more than 19.999%, then you do that. And you can also make a loan to a third party.
Right.
Okay. So this is one of those sexy things that we were talking about.
My ears are pricked up already now.
Yes. So you can make a loan from a SIPP to an unconnected third party.
Okay.
And as with anything rulebook wise, it's particularly grey on what's classed as a connected or unconnected party.
Yeah.
So again, a lot of it is case by case basis.
Okay.
But as a rule of thumb, if it's family or a business partner or a JV partner or something like that, then it's generally going to be classed as being connected, because you've got an existing relationship there.
Yeah.
But a friend.
Yeah. Again, I hesitate because there's no definitive yes or no, but if what's that phrase? If it looks like a and smells like a, it's a
Yeah.
If it looks connected, then but again, on that, it's probably case by case basis, really. But if you're looking to loan to your spouse or partner, then clearly, So because that loan is to an unconnected party, touching on something you mentioned earlier, Mark, is that you're free then to negotiate market terms.
Yeah.
So you're not bound by particular rules or anything like that. So technically, you can loan out up to 100% of that pension fund to a third party.
Yeah.
Now, you're unlikely to find a provider and a trustee that's going to let you do that, because the risk involved in it is kind of astronomical, really, especially given that there's no necessity for security or anything like that. So
we're slightly looking at the other side of the coin here now, aren't we? We've sort of drifted into another really interesting area. So, this has got my brain thinking around kind of conversations with potential angel investors and that kind of thing, who may not have considered that their own pension pot is an opportunity for them to invest in you and in your property business as well. So this is kind of what we're talking about, isn't it? The kind conversations and questions to ask potential investors about what they're doing with their pension funds, where they're invested, and what sort of pension they've got.
Definitely. Especially, if you think, and quite rightly so, and we've touched on it a few times, that people would look at pensions as this pile of money that it's sat there, I can't do a lot with it. I get my statement, I might open it, depending on whether I want to, but most of the time it just goes in a drawer, gets forgotten about, and then you come to retirement, you open it up and you go, oh, I'm going to get £500 a month, or, well, if you're lucky, probably more, £500 a year. But yes, if you can take a keen interest on it, and using that example, if you had a conversation with an angel investor and you could get yourself 8, 9, 10% yield on that loan, then that's going to be a lot, potentially a lot steadier rate of return than you might potentially get on the stock market, for example.
And again, they don't have to wait to retirement age to be able to do that. That's something that they can put their pension to work for a much better return, as soon as they want to.
I mean, a lot of it comes down to economy of scale. You've got things to factor into it, and this is with any of these, whether you're buying a property or loans or anything like that, you're going to have legal fees.
There'll be costs.
You've got legal fees, you've got the trustee fees, so you've got to really kind of have a bit of a pot to start with, but theoretically, yes.
Proportionally, it's got to be worthwhile in terms of the fees and stuff. Okay.
In a nutshell, that's SIPPs. Okay, there is a lot more things that you could potentially do with them, but kind of what's going to be of most interest to the listeners, and that's probably where it kind of ends.
So in terms of I know there'll be people. So actually, Andy is another community member who posted a question, and his question was around pooling together, consolidating his resources, if you like. He's worked for a few different companies. How does he go about? Well, can he consolidate those pension pots, and how does he go about finding out where they are, what they are, and how does that process work? So that, because I'd imagine there'll be people out there that are really interested in what we're talking about and thinking, right, I know I've got X, Y, and Z, kind of dotting around. How do I consolidate that and take an overview of what's best to do with it?
Yeah, you would have thought that by now there would have been an easy way of doing it, wouldn't you?
Like a central hub database.
Yeah, the pension regulator a few years back were actually looking at bringing something in. They were going to call it the pensions dashboard. And the idea is that you'd be able to log in and it would list all of your pensions. It's kind of gone a bit quiet on it.
Right.
I think they realised they were maybe being a bit overambitious, and the fundamentals of getting it all in place and getting all the providers to import all of their information into a system. I think they've just kind of swept it under the rug for now.
Without getting too geeky over it, you'd imagine the technology exists though, right? With credit
bank accounts, isn't it? It's like online banking, but for your pension.
Clear Score and all the credit people that consolidate everything into one dashboard. You'd assume that the technology's out there.
Yeah. You would have thought, but
it's playing catch up.
Yeah. Again, I think that the problem with it is that, say, for example, you've got your big insurance companies, and without naming names, there's one that has a green and yellow logo with blue writing, based over in East Anglia. Over the years, they've amalgamated and brought out a load of smaller pension companies, and they're all using old systems because they would have just inherited the system that whatever that company that they purchased has used. And I found that firsthand. Before many moons ago, before kind of moving into pensions, I worked for a big insurance company. Not that one, a different one, but they were still using MS-DOS as their back office system. So I think a lot of it is maybe, and again, I'm not privy to the information that the big insurance companies have got, but for them to upgrade all of their systems to be in a place where it would talk to said database.
It would eat a lot of people's pension money, I guess.
Well, that cost's got to be put on somewhere, hasn't it? And the insurance companies, they use the stack it high, sell it cheap method. So unfortunately, there isn't a central database. What we can do though, and one of the services that we offer is we can try and track them down for you.
Right.
Okay. So we need some kind of basic information from you. So
company details, where you work, when you work there.
Sometimes it's we kind of strike gold straight away. A lot of the times it's trial and error. You may have been in a pension scheme that's changed names 4 different times over the last 20 years, and often it's a case of just trying to follow we can write off to one and they say, oh no, it's owned by this company, and then we'll write to them and then it's owned by this company. And again, that's one of the failings of the pensions industry, is that there's been that many different name changes and that many different amalgamations. But yes, there is a way of us doing it. Unfortunately, it's not as straightforward as it probably
it's a bit of a manual process, but once you've tracked down the various pots, it is then possible, presumably, to consolidate that and to strategize about what sort of scheme you consolidate it into. So obviously we've talked about SIPP, and there'll be other types as well. So, but you can do that, you can pull it all together and then decide where it's best positioned.
Absolutely, yeah. Well, part of the process you'd have to go through, and again, this is part of what we would do if you were kind of engaged with us and doing it, is you'd need to make sure first that there wasn't any hidden benefits or anything like that in any of your plans. So, generally, the older a pension is, and without getting too off topic, but generally, the older that a scheme is, the more likely you're going to have what's called a safeguarded benefit.
Okay.
So it may be that it's got a guaranteed growth rate or a guaranteed minimum value, or something that's guaranteed, that basically if you were to move it, you would lose. So you would have to be kind of make sure of that first. Do your prep, do your research. Then yes, you can then consolidate them all together. So instead of you having 5 or 6 different letters coming through all the time that all go in the drawer, you could just amalgamate it into one, and kind of away you go with one scheme.
So that seems, if a little clunky, reasonably straightforward to understand how you would do that. So okay, perfect.
The benefit of it is once you've done it once, then hopefully you wouldn't need to do it again.
Cool.
If it's that difficult to actually track the pension down, John, are you definitely going to get the money out of the pension company? Or if they're fobbing you off from provider to provider, is there a chance that at the end of the day the pension's gone walkabouts?
No. I mean,
Okay.
your pension wouldn't just disappear. It might be hidden somewhere, but it wouldn't. If you put that money in and you built up that entitlement, then it's yours. You know, it's just a case of trying to find
it.
Yeah, basically. Yeah, it's the FCA have some things called treating customers fairly, which all providers and advisors adhere to, and part of that is removing barriers to trade. So they can't really play hardball that much because the FCA would kind of be on them. But it's more just trying to find it, really.
All right, that makes sense. So tell us about SSAS pensions then, because I think that's the other main type, isn't it, that we should potentially be interested in from a property point of view. So tell us a bit about those.
Yeah. So if you think personal pensions are your most basic type, SIPPs are your middle of the road. SSASs are like your high end, kind of Ferrari of the pension world. So SSAS stands for Small Self-Administered Scheme. Okay. And without going into too much detail about the differences between SIPPs and SSASs, because fundamentally there are a lot of differences. A couple of the key ones, which are going to be the most pertinent ones, are SIPPs are individual contracts. So a SIPP, if the three of us had pensions, we would each have our own SIPP. Whereas SSASs are collectives. Okay. So in a SSAS, the three of us would pool our money together into one SSAS.
Right.
Rather than us having three individual SIPPs.
Got you. Okay. Yeah.
You can have up to 12 people in a SSAS. So it gets to a point where, because SIPPs, if you think personal pensions are the cheapest, SIPPs are the middle band, SSASs are the most expensive, it becomes a point where economy of scale kicks in, where is it cheaper to have one SSAS against 4 SIPPs, for example? SSASs are all individually registered with HMRC as well. So you've got the fact that there's potential time delays on setting up a SSAS. Whereas with a SIPP and a personal pension, they're all based on a master trust. So it's already pre-signed off by HMRC. But SSASs are individual contracts. And so at the minute, given current turnarounds, we did one a couple of weeks ago that took 7 weeks to get signed off.
Not huge amounts of time then.
No, it's been worse. It's been a lot worse. It's been better as well. It all depends on timing. If you're going to try and do it around a tax deadline, then you expect to wait a bit longer. But then it's all down to how many applications they have and what their staffing levels are like. So there isn't a definitive it takes this long. It takes however long HMRC take.
So what's the incentive? What can you do with a SSAS then that you can't do with other pension schemes?
So primarily, the key difference between a SIPP and a SSAS, and this is the one that a lot of people talk to us about, is you can make a loan from your SSAS back to your own business. So whereas in a SIPP, the loan, if you're going to do it, has got to be to an unconnected party. In a SSAS, you can still do the unconnected loan, but you can loan money back to your own business.
Right.
And I'll kind of run through that because there is a set of because it's a connected transaction. There's a set
I
of.
was going to say, are you limited then in terms of what rate of return you can offer and that kind of thing?
Yeah, absolutely. So the rules are you can do a maximum of 50% of your pension's value. Okay. So again, using the £100,000 example, you could make a loan of £50,000 from your pension back into your business.
Yeah.
Okay. So the best way to think about it is it's two closed loops. Okay. You've got the loan from the pension scheme to the business.
Yeah.
And then you've got whatever the business then does with that money.
Yeah.
Okay. Now, regulatory hat on, that loan has got to be made to that business for a genuine business purpose.
Yeah.
But if that business is a property development business,
it's likely to have one. Yeah.
It's a genuine purpose, isn't it? At
Yeah.
that point.
Yeah.
So the first closed loop, pension scheme to business. So maximum 50%.
Yep.
Maximum term of 5 years, but you can rebase or roll it over.
Okay.
The repayments have got to be capital and interest. So you can't do it on an interest only basis.
Okay.
The repayments have got to be at least annually.
Yeah.
Okay, so you could do it monthly or however, but at least annually.
Yeah.
And then the next two are sort of the two really that cause the most sticking points with them. Okay. The first one is the interest rate has got to be at least 1% above base.
Okay. Yeah.
Which has been great.
It's cheap money at the moment.
Yeah.
Yeah.
So you could go one of two ways with that. Okay. You could either do it and charge yourself, say, 1 or 2% above base.
Yeah.
Because you would still have to evidence that it's a commercial rate. And you've got to think that these rules were introduced when interest rates were sort of 4 or 5%. So,
yeah.
So you could give yourself really cheap borrowing.
So that would really help if your business was at the stage where it was looking to grow and scale, and it's cheap borrowing, great opportunity to get a project off the ground, etc.
Yeah, where potentially, you're a fledgling business, the banks might not look at it. Some mortgage lenders might be a bit, they might not want to lend. It's an alternative to that, really.
So presumably you could also lend at a considerably higher rate, which would then have the reverse benefit, I guess, wouldn't it, in terms of tax advantages to the limited company?
It's as if you'd read my mind. Yeah. So the interest on that loan repayment is a business expense.
Yeah.
So if you've got a high corporation tax bill, you could charge yourself, as long as, again, it's commercially viable and commercially justifiable.
Yeah.
The interest then reduces your corporation tax, but then has the same effect as the rent earlier, like we mentioned.
You're helping to build the pension pot.
So the next time that you look to do a loan, you've then got more money in there. So the 50% is of a higher figure. So again, from that perspective, it's quite cyclical.
Yeah.
Then the kind of the kicker really is that the loan has got to be secured as a first charge.
So no mortgages involved. Yeah.
Now, again, it depends, and this is where it's really, really important to choose the right provider and trustee, because each of the different SSAS trustees will have their own different risk appetite and different interpretations of what they'll let you use as security. So kind of at the most basic end, if you've got kind of cash in the business or stock or kind of anything like that, you could look to take the debt over that.
Yeah.
Or what we've done quite a bit with some clients is look to take the security as a debenture over the business.
Sits over any assets then within the business. Yeah.
Yeah. So you're not putting a physical asset up.
Yeah.
It's a floating charge over the business.
Yeah.
That works really well for clients who might go for the strategy of sort of remortgaging, using that equity to then buy another property, remortgage, buy a property, etc.
Yeah.
Or if you've got an unencumbered property, you could look to use that.
Yeah.
Now, if you're going to look to use security over something that a pension can't ultimately own, so say a residential property, for example, then more often or not, the security will be taken over the cash value. So the pension can't ever claw in that security because it can't own that residential property.
It could enforce the sale though.
That's what would happen. Yeah. So I've had the question a few times from people where they've said, oh, well, my main residence is unencumbered. Could I use that security? And technically, yes, you can, but you probably really shouldn't, because they would come and force that sale. But again, that's each different person's different set of circumstances. So providing that you can meet all of those criteria, then so we've moved that, we ticked all those boxes, everyone's happy, HMRC are happy, the pension trustees are happy, you're happy. What that money then goes into the business. There's a loan agreement in place. Business pays the loan back, pension's got its security, pension's happy. That money then sits in the business. It's outside of the pension scheme. So it's then nothing to do with the pension. So you can then use that money once it's in the business to then buy
residential.
Or whatever your strategy is. Because like I said earlier, it's two closed loops. They're individual from each other. So to kind of put it as a kind of a full loop, let's say you use that loan money in the business to buy a HMO. Rent comes into the business. That then pays the loan repayments.
That's really good. Is all of this is a great example, isn't it, of knowledge is power in a sense. Just by hopefully this has helped people at least think about their pensions in terms of them being something that actually they can utilize as a resource, if you like, and if they're strategic about it, they can actually benefit from that pension, and also even potentially bolster the pension itself. Just by understanding some of these things, you realize that that's a really powerful conversation, both in terms of your own situation, but also potentially working with investors and other people as well.
Yeah, definitely, because what a lot of people then sort of forget about is that if they do the loan, they've still got 50% of their pension funds sat there, which you could buy a commercial property with, you could buy some land, you could
loan that to someone else.
Exactly.
Because the bottom line is, like, most of us are likely to have a pension that is not going to take care of itself in itself. It's not going to support us in terms of how we would like to live, meeting just even basic living costs, I guess, after retirement. So this is a way to potentially, I guess, like we're trying to do in any investment way, is make that particular pot of money go further and work harder.
You're taking control of your own destiny, really.
As
opposed to letting an insurance company just put it in a default fund that trickles away, and you never have any sense of what it's doing or what it's going to make you or anything like that.
Absolutely.
You're looking at that pot of money thinking, well, I can do something with that. I can help further, if not my own portfolio, I can help a JV partner, or I can be an angel investor or something like that. And then at that point, you're controlling your own yield, you're controlling your return, you can control your investments.
So you would never invest your own kind of savings into something that you didn't know or you had no control of. But I guess so many people kind of wander into their pensions doing that for them because they don't realize that there's a better way.
Yeah, and a pension is essentially a glorified savings account. It's just that if you know what's available to you and you know what the options are, I think that is probably one of the biggest failings of the pensions industry, to be fair, is they do make it unnecessarily complicated. So people do switch off, and I know we've joked about making pensions sexy, but I think that just kind of hammers home the point in itself, is that the fact that you have to joke about making pensions sexy, shows what the sentiment around pensions are generally. And you know, yes, like I said earlier, I'm not here to defend the pension industry, but if you invest that little bit of time actually learning what opportunities that there are out there, then you know, in some cases it's quite a big chunk of money that you can unlock.
As I say, you bashed away a lot of the kind of the preconceptions that do exist around pensions as well, which is really good, and it just goes to show they're not as scary and they're not as you know, kind of dangerous as some people think they are.
Yeah, it's a massive topic area, isn't it? And I think that you know, in a sense, you know, I can easily envisage we're going to be revisiting some of this in more detail in future episodes. I think all we could probably hope to have achieved today is just exactly that, like open people's eyes to the options, and so they understand how they could potentially put their pension to good use. I know I'm like most people now. I think I'm off to the filing cabinet after this to dig out the information that I've got, and you know, if we've been able to achieve that, I think that's going to be a really positive thing, just to get the ball rolling and get people thinking differently about their pension and how they might be able to put it to good use.
Definitely, and you know, like you say, if it means that it's highlighted even one thing that you didn't know that pensions can do, then hopefully it's been a good use of an hour.
Yeah, absolutely. So that's been fantastic. I know I've learned a huge amount from that. I know everybody listening will have got a lot of benefit from that, a lot of information for that. So thank you so much for your time and your input there, John. If people did want to reach out to you and get in touch or discuss their circumstances or find out more about what you do, what's the best way for them to do that?
More than happy to have a chat to anyone, whether it be, you know, can you help me find out what my old pensions are, or I've got this scenario, would this work, or just generally have a chat, you know. I'm up for that. Best ways to get in touch with me are either email, so it's John, JON @charlesdeanuk.com. Mobile is 07584 012 369. Website is www.charlesdeanuk.com, and there's a contact us section on there as well. So,
and we'll pop all of that into the show notes as well down below, so they'll have all those contact details as well. So that's fantastic. John, thank you so much for your time. That's been absolutely brilliant.
Excellent. Thank you so much.
Take care. I hope everybody enjoyed that episode, and we will catch you on the next one.
Yeah, looking forward to speaking to you all soon.
See you soon.
Guys. Thank you.